What if I told you buying a truck, changing jobs, or even getting married could put your home purchase at risk? Seriously, getting married can kill a deal? Maybe, or maybe not. Today, we're playing Deal Killer or No Big Deal and testing some of the biggest mistakes buyers make before closing. Stay tuned. Well, happy Wednesday, everyone, and welcome to the Mojo Show, your real estate podcast where we talk about everything real estate. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage.
This week's episode, we're talking about the do's and don'ts when buying a home and what can kill a deal and what might not be that big of a deal at all. Can you guess the right answer before Joe and I do? But before we get to that, of course, a little coffee talk with the Joes this morning. We were just discussing before we went live as far as summer vacations, and I think that's a great topic. I'm curious, those of you that are listening in, are you taking a summer vacation? And if so, where? Drop it in the comments. Joe, how about you and your family? Are you going to be doing a summer vacationing this year?
So we are finally doing another one. It's been a couple of years, our market, the transition, changing over to NXT for the last 3 years, trying to put in all the time, and then the move to Nebraska. We haven't taken something as a family. Well, we are this year. We're end of July. We're actually going to go to Destin, Florida.
Nice.
We found a VRBO. I will share the link when we get back and I show pictures. But we found a VRBO that we're excited to go to and just have about 5 nights, just the family, just the 4 of us.
Nice.
And, just relax before they go back to school, in August. So what about
Nice.
you guys, Joe? What do you guys got anything? Or
Oh, every day is a vacation at my house. Come on. I mean, no, this year, this summer, and I'm trying to think really the last time I actually took an actual vacation was just over a year ago with my honeymoon. Besides that, I mean, haven't an actual true vacation, if you will. Haven't just been, since moving here almost 3 years ago. This August, Joe, will you believe it's been 3 years since I moved here to Houston?
That's awesome.
And, continuing to grind it out. I think the summertime is a great time to, really bust it out and take advantage of the market that we're in right now and just kind of, grind it out and work hard. And hopefully later in the year, maybe take a side trip or something like that. But,
I think a lot of people right now too, with what's going on and cost of fuel and everything else, staycations are starting to become a big thing.
Yeah.
They were a big thing back in Arizona when we lived there. You just go and book a resort there and just take your family. Mm-hmm. We did that a couple of times over the last year where like 2 night stays somewhere just to kind of get away from the house. Those are, relaxing. And the nice thing about those is I'm not taking my computer on a 2-day thing, but I will be working when we go to the VRBO in July in Florida. I will be working. I will say in our industry, that is not a luxury that we get to really take away a whole week and not do anything. So
agree. I think when we do go on any vacation, I mean, I remember even on my honeymoon, I took my laptop with me and was working on the patio or lanai there and just working, trying to get pre-approval out, for my client. And then we headed down to the pool.
It's a lot easier now to work in the mornings on these vacations because your 17-year-old daughter and your 19-year-old
they're sleeping in.
Oh my gosh, Hunter turns 20 in 3 days.
Really?
20.
Wow.
So, and then Tina likes to sleep a little bit. So I can get work done for about 3 hours in the morning and not be interrupted. So it's nice.
Absolutely.
So, Well, I'm excited about today's show, Joe. Let's tell everybody what we're going to be doing today.
So today, what we want to focus on is kind of the do's and don'ts, if you will, for home buyers while they're buying a home. Not only just before, really from the stage of getting pre-approved to the closing of your home, things that you do and don't want to do, right? So kind of almost like the 10 commandments of buying a home. You don't want to do these things. Thou shalt not, if you will. But we're going to kind of go through them. If everybody remembers the show Deal or No Deal, we're going to go through it a little bit of a spin-off of that as far as a deal killer or no big deal. So we've got several rounds. I don't know if we'll be able to get through all rounds, because we got like 10 rounds that we've got for this
built out for us.
Killer or no big deal. But let's jump into the first one here, Joe. And I'll go ahead and pose this to you to see, is this no big deal or is it a deal killer? So let's say that the buyer buys a new truck 2 weeks before closing. Can that kill the deal?
So I have follow-up questions because me, I can't just give you a deal or no deal thing here. So I've got a couple of questions.
Here we go.
Now, bought a new truck 2 weeks prior to closing. One, I'm going to tell you that's a big deal. Don't do it.
Right.
But does it kill your deal is where this goes. Right. So did they trade in a truck or a car and the payments be the exact same as what you're already accounting for?
Good question.
Because is it a pain? Yes. We just got to get the paperwork. We got to show it. It's not going to do it. Now you bought a new truck and you did not have a car payment prior to. And now all of a sudden I have $1,000 payment because honestly, let's be realistic today. Trucks are $60,000 plus for some reason.
Yeah.
And somebody's going to comment 60,000. Where do I get one of those? but so now all of a sudden I got $1,000 payment and my debt to income ratio can't afford it. Now my deal is dead.
Yeah.
And I can't do your loan anymore.
Yeah.
So if you're going out and buying a vehicle during the loan process, don't, because it more than likely will kill your deal, or it's going to cause a lot of stress and a lot of pain, and you're risking your earnest money.
Yeah,
because that is completely on the loan approval. And if we don't have that information, 14 days usually is what they give us to get a loan approved before that contingency's up. And 2 weeks out from a closing, that contingency is usually over. So we're in a lot of trouble there. Yep. So, Joe, now we've talked about this before, and I had one of my best friends do that to me, 2 weeks prior to closing on their new purchase, and I had to flip it. Luckily, I was able to do it. But have you had that circumstance or that situation happen?
Actually, recently. So last week we closed on a home for a couple. And the husband, I think it was back in February, called me because I'd been working with them for a few months and helping with their credit, in building it up where we needed to be. And in February, he's like, my vehicle broke down. I need to buy a new one. Is this going to, damage things? I'm like, well, being that, you're not, we don't have you pre-approved yet. Right. And what the car payment you have right now is this much. What's the car payment going to be on the new one? It was like $100 more a month. I want to say $115 more a month. And in calculating it in, it wasn't a big deal. Now it did become a big deal though in underwriting, because we didn't have that payment showing. Yep. Right, on the credit report yet, right? Yep. As well, it ended up dropping his credit score because it's a new liability. Yep. So anytime you open up new credit, yes, it's probably going to decrease your credit score. And it decreased it 2 points below what we needed it to be. 2 points.
And
right?
that's the hard thing that people don't understand is not that you bought the car. It's all the other reasons that it can change up.
It can affect
If
things.
we have to repull your credit and your score drops, it can change your pricing.
Yes.
It can change your qualifying.
Yes.
There's a bunch of different factors. And so I love that you just explained it the way you did, because you just brought into like 4 other things that could affect other parts of your loan instead of just the debt to income ratio.
Yeah, exactly. So
that's a good one. All right. And guys, when we're doing this, please ask questions in the comments.
Yeah.
Or if you have a situation, if you're a loan originator, you have a situation that happened, we'd love to hear about it. We want to talk about it. But if you're a first-time home buyer and you're like, hey, if I did this, put it in there. We'll answer that question too. But Joe, I'm going to go to the next one for us.
Okay.
All right. Borrower is a salary employee.
Okay.
All right. So you qualified them on salary.
Got it.
During the process, they switch to commission only. Ooh. Or within the same year, they switch to commission only.
Oh,
deal or no big deal?
Well, I'm going to play you here and ask additional questions. Right?
I set it up. I said during the process or within the same year.
Yes. So, and by the way, if you have an answer on this, if you think you know the answer, drop it in the comments. Let's because we'd love to get a different viewpoint as well on this stuff, right? So are we talking that they went commission from salary, full salary, to 100% commission? And is it like self-employed 1099 or are we talking they still have like a base salary?
So I'm going to put it into this perspective.
Okay. All right.
You're a loan processor making a salary, and you switch to being a loan officer W-2 commission only.
In that respect, it's going to mess everything up. It just is, right? Because here's the thing. That's commission, everyone. When we look at commission, it's what we call variable income. Okay. And anytime that you have variable income, we need a 2-year history of it, 2-year history. So if you just switched over to that, I'm sorry, you just messed everything up.
Now, if you don't have a 2-year history, Joe, is that a killer?
Oh, man. See, okay, what type of loan, though? What type? Are we conventional, Govy? What are we talking?
I'm going to say conventional or FHA.
You might be able to get away with 12 months, but I mean, unless you get, bottom line, I'm just going to put an umbrella over it. Unless you've got 2 years, forget it.
Yeah. So I would say the best way to look at that, and as you guys are listening to this show, make sure you understand, Joe and I have a lot of experience with doing loans and all this stuff. A newer loan originator might not be thinking of these questions on how to overcome it. So you're going to get an answer of, well, we can't do it. Well, what comes to my mind is I have a client that just switched from salary to commission, same company, and have been commissioned for at least 12 months. Mm-hmm. Then there is a likelihood that we can get an underwriter exception to make it, as long as we can do an average of that commission income to support the loan. Mm-hmm. Now, if you have less than 12 months at the current employer, and you don't have any commission prior to, there is not a way that I can come up with that unless you're self-employed and we have to switch to a different product. But that is a big killer if you have less than that 12 months on current job and less than a 2-year commission. That can really hurt us in that case. And I don't think this one's on one of our topics, so I'm going to say it real quick. True. Same thing as if you go from being a W-2 commission person to a 1099.
Yep, because
that one can kill us. So, we have a comment.
Oh, drop it in here.
What are y'all talking about? Christian Hickman.
Okay.
So we are talking about the do's and don'ts, basically. What will kill a deal, and is it no big deal? We're kind of just doing topics, and this topic right now, Christian, if you just chimed in, was salaried employee moving to commission. So does it kill your deal or not? And that's what we were talking about.
And we're talking about while you're in underwriting. Okay. You're under contract and purchasing a home and you're in underwriting and you switch from salaried to commission.
Yep.
Retaliate. Okay. All right. So let's move on to the next one here to see if this is no big deal or if it is a big deal, a deal killer. Joe, what if while in underwriting, we're under contract to purchase a home, while in underwriting, a late payment shows up on a credit card? Is that going to kill the deal? Or no big deal?
Again, we're going to go back to how did we find out that there was a late payment on a credit card if we're already in underwriting is a big question here for any loan originator, because we don't usually, if you're buying a house, we don't usually re-pull your credit, but we do some refreshes to see if balances go up and things like that. So if the investor requires, because not all investors require this, but if the investor requires a refresh to see, is there any new balances, new credit, and it shows a payment history that comes up and shows a late payment, it can affect your deal. But a lot of times we don't have that happen. During that process, by the time we pull credit, we have 90 days for that credit report to be really good. They expire at 120. The reason I say 90 is because we got to get it over to the investor. They have to do their stuff. They need that other 30 days. But we don't really pull credit again. So if you missed a payment, but you caught it before that 30 days or things didn't come up, we might not know it.
Right.
But if it shows up, an underwriter could make us re-pull credit to see what your new FICO score is that could drop it. But a lot of times that one's not as big of a deal as long as we're already got a hard pull, we're under a contract. But I will tell you, it is a huge deal for your credit. So do not miss that payment.
Agreed.
So, Joe, you agree with all of what I said?
I do. Absolutely. Good stuff.
All right. I got a new one for you.
Okay. What's up? Give it to me. Deal or kill a deal?
That's right. So buyer right now under contract, we're moving forward. You get my most recent bank statement and I've got a $15,000 deposit in cash.
Oof. This, yes, it can kill a deal. Here's what I'll add to this, because I'm not going to ask additional questions. I'm just going to play it into it, right? First of all, money has to season, right? The money is going to have to season, what we call it, and typically it's 2 to 3 months. Seasoning is needed in the bank account before we can use it. Now, those funds, if they get dropped in there, if you plan on using it for the down payment closing costs, then yes, it can definitely affect things, right? It can, because here's the thing. If I'm going to use numbers of, let's say that your monthly income is $5,000. Okay. $5,000. If you have deposits that are more than 50% of your monthly income, that's going to throw a flag on the play, right? And we'll have to be able to have that money become seasoned, or in the events now. And here's a caveat to it though, because I know, and I'm going to change it a little bit, because you said cash, right?
Yep, I said
cash is put in there. However, if you're getting like a gift of funds from a family member, right? I mean, we still have to be able to trace the paper trail, if you will, of that money, right? And as long as, let's say, mom and dad gave it to you, and it came from their bank account. I know I'm changing that a little, but just so that we have the different branches here of different scenarios. If it comes from their bank account transferred over to you, and we can show the paper trail of it, then it'll be fine. We can use it. But if it's strictly cash, so if you got cash in your, under your mattress, you pull it out and you stick it in the bank at 15 grand, we're not going to be able to use it. Matter of fact, I actually had this with someone that's in underwriting right now, right? And they asked me, because they have silver silver, I don't know if they're coins or plates or whatever that they wanted to cash in for this. I'm like, you're not going to be able to, right? Because we have to have that money seasoned first before we can use it. So any caveats to that, Joe, you want to add to it?
I mean, you answered a lot of it. There's some ways that we can get around it. But if you're depositing cash and you're not in a cash business, right? Make sure you guys understand this. If you're self-employed and you're in landscaping, you deal with cash, or if you're in car sales and you deal in cash, like, people coming and paying, there are some ways that we can get around that. But in general, cash cannot be sourced. So if you cannot source it, we can't use it. Same thing with credit card advances. Can't use that. It's not an eligible source. So do not do that either. But cash is one. So,
Joe, you want to answer this for Sandy? Sandy, thank you, by the way, for tuning in. Appreciate it.
Why do they care where the money comes from? That is a great question. The reason they care is for anti-money laundering. They are making sure that we are not allowing money that is made fraudulently to be used to reinvest. And it's anti-money laundering is what they're looking for. It's not somebody like yourself, Sandy, that just put some cash under the mattress or put it in a safety deposit box and you're pulling it back out because those funds were valid. It's really watching the people that are trying to clean money, trying to escape around the government from IRS standpoint. A lot of those things. It's just another way that we're trying to stop the fraud and stop, hurting people that truly want to buy homes the right way. So that's the best way I can put it. And we have to do a test on anti-money laundering every year, compliance and everything else. So it is a big deal, but that is a very good question because I get that a lot from clients.
So here's one I got for you. Moving to the next one here. What if, and I already know the additional questions that you're going to layer on top of this one. So I'm going to kind of rephrase this. So a buyer gets married during escrow and it's an FHA loan in a community property state.
Oh, so people are wondering why you had to share all those details.
Yes, they probably are.
Joe shared those details to stop me from asking a bunch of questions and eating up time. So with what you said there, we are going with a government loan in a community property state. And on government loans like FHA, USDA, if you have a non-borrowing spouse. So if I am married in a community property state, my wife on a primary has to go on title. Okay. There are some things people can argue. Well, what if the funds were prior to marriage? Don't get into all the weeds on this. If you are married in a community property state, government is asking us to look at your debts for the non-borrowing spouse, and they have to be accounted for in that debt to income ratio. So when that happens, can it kill your deal? Yes. Because all of a sudden, my new wife has, or your new husband has debts that you didn't know about, or student loans that they're not making payments on. All those now come into account for your approval. So that is a huge deal. It also changes up your contract. It changes up titling. And there is a document at closing that you sign that your marital status has not changed since you on a refinance since you bought the house, but on a purchase since you went under contract. It's asking you all these things. So that is a very big deal. And then I saw a text message go off from Glenda over here. So I was wondering if she was already doing it.
Thanks, Glenda. Yeah, just hold off. Just wait. You waited this long. Just wait a couple more weeks until closing.
Wait until you have keys in hand, and then you can go get married.
Then go get married. Yes, absolutely. Good stuff.
We have another one in here.
Yeah, actually, Christian jumping back on. I guess she went to school with Anna.
Okay. I did not know that,
okay.
Christian. So
thanks for tuning in, though.
Yes, thank you for tuning in. And I actually saw a friend request from Christian on Facebook this morning, so I'll probably be going back and checking that out. Christian, we appreciate you jumping on and listening to us. Joe, I've got another one for us. We have about 6 minutes left. when I'm buying a new house, I'm excited. I'm
Okay.
so excited.
Mhm.
We are going to Nebraska Furniture Mart. Biggest store in Texas, biggest Nebraska furniture store over there in Frisco. And I am buying furniture for that house.
Okay.
We're closing on in 3 weeks.
Okay.
So big deal, no big deal. And by the way, I got that 0% interest on that credit card.
That was going to be my next question. How'd you pay for it? How'd you pay for it? Cash? Tell me you paid cash.
No, I opened up that 0% on that credit card.
You got suckered into it, didn't you? Okay. All right. Well, it's possible that it can kill the deal. It's possible, right? But what we need to do is to be able to get from the company that you're getting the credit from, right? As far as the structured payment of what that's going to look like, right? Your monthly payment, so that we can add that to your debt to income ratio. Now, that could put you over the threshold as far as your DTI or debt to income ratio. It could. So this could be a deal killer, but maybe not.
That is where it gets difficult, because when you open up a new trade line, that is what we talked about when we do a refresh credit to make sure there's no new debts. That's when the
credit
pops
score
up.
could dump.
Right. So that's where this one will come up. We don't pull new credit, but we do check to see if there's any new credit that you opened up. The problem with it is a lot of times those credit card companies, they don't generate a statement. They don't give you a summary. They don't show you a payment until 30 days goes by.
30 days, yes.
So that's where this becomes an issue, because we can't supply that to the underwriter. And so we have to sometimes use 5% of whatever that balance is. So if it shows a balance of, whatever the dollar amount is, if it's 10 grand,
yeah, whatever, right?
do 5% of that. And now that's what the payment is that goes to your debt to income ratio. So that can be a huge deal when you do that. So I always say, no new lines of credit, no appliance purchases, no big purchases until you have keys in hand.
Yep.
Not the day of closing.
Yep.
Keys in hand.
Well, and this actually came up Memorial weekend. The clients that we closed last week, right? He texted me and says, because they're super excited. It's their first time home buyer, and they want to go buy furniture. No, I think it was a refrigerator, right? They wanted to go buy a refrigerator.
Yep.
But they wanted to, not using a credit card. They were going to use cash, right? And they wanted to use the cash that they had in the bank account, right? And we're so tight on the cash to close, and we've already vetted the money that's in their bank account, right? So it's like, please just wait 3 more days. Just, I know Memorial weekend, they probably got some specials going on and stuff. Please wait until you have the keys in hand, then go get it. Right. Because if something pops up, last minute underwriting or something, and you need more funds and you've just spent it on that refrigerator, what are you going to do? Where are you going to get it? So again, keys in hand, then do it.
Yep.
Fair enough.
That is fair. I think we got time for one more, Joe.
One more? You think so?
We have time for it. So
this one I want to pop in real quick, because I think this would be a good one to end with. Let's say while you're in underwriting, the appraisal comes in and it's low.
Oof.
Let's say it comes in. Let's say it's a $400,000 purchase price, and the appraisal comes in at $385,000.
Oh,
what happens, Joe?
So
is that a deal killer?
Not always, and I'm going to say not always. A couple of things that you have options here on is, one, and most importantly, your agent. This is why we always say, make sure you're using a professional agent. Your agent will see that the appraisal came in low. They will talk with, one of us if we're your lender, and we will go over options of, is there any other homes that the appraiser did not look at that supports the higher value? And can we go back and supply them these new comparable sales to increase that value. That's one option.
Mm-hmm.
That is not one that happens all the time. I will say I probably lose. It's kind of like a batting average in baseball. It's way under 50% of the time, right?
Yes.
That we are striking out on those. And so I would say that is the first option. The second option is if we can't get a value there, your real estate agent is negotiating with the seller's agent to see if you guys can get that price down to what the house is appraised at, what the fair market value is based on an opinion of an appraiser. Mm-hmm. Okay. I always say that because people are like, well, appraisals aren't facts. Correct. It is an opinion of that appraiser based on the information that is provided to them or they get. So those are your options there to get it down. Your third option is you love the house, you have the funds, and you can make up that $15,000 difference. It's going to add that money that you're bringing to closing if you're already maxing out the minimum down payment loan amount, right? So if you're going with a 95%, there's not much more room, so you're bringing that 15. But if you're putting 20% down, we could possibly take that up a little bit, and you're not bringing the full 15. So a lot of information there, Joe. I could keep going about a whole show.
I know that's one we could go pretty in depth on. We definitely can, but I know that we're out of time, and I don't know about you, but that was fun.
I like this one.
Yeah. We hope all of you had as much fun as we did today with today's episode. And hopefully you learned something. You're walking away with something that you've learned to be able to use as far as you purchasing a home, whether it's something that would be a deal killer or maybe not that big of a deal. If you've got scenarios, though, that you want to discuss, well, what if I did this, Joe? Feel free to reach out to us. Joe's going to put up on the ticker below as far as our email addresses, how you can get a hold of us. We'd be more than happy to reach out and have a conversation to help, because we want to make sure that you're in a good position when it comes time to purchasing a home, and not one that's going to hold you back for 6 months, right? So next week, I'm not going to release as far as what we have going on next week. You're just going to have to find out because it's going to be a good one. So stay tuned for that. Matter of fact, even better still, be sure to go to our YouTube channel at the Mojo Show Real Estate Podcast and hit that subscribe button, right? That way you're not going to miss out on any episodes. Plus, we are on a mission to get to 1,000 subscribers. And of course, every like, share, and comment helps us reach more homeowners like yourselves. So before we close things out, Joe, any last words or nuggets of advice for our listeners?
I will say that there's a bunch of do's and don'ts. The biggest takeaway is do not open up any new credit. Do not have your credit pulled after you figure out which lender you're going with. Those are the big things that can really hurt your loan approval, in my opinion. So.
Absolutely. Well, I'm Joe Mortgage, and that handsome guy with a beard is Cup of Joe Mortgage, and we'll see you next.